Okay, so first up, we've got the accounting rate of return. Now, as you worked out, this is using, the name probably suggests, this is using accounting numbers, and this probably leads you to think about this being one of the dodgiest ones. And the reason it's dodgy, not because accounting is dodgy in general, but because accounting rate of return tends to use accounting numbers such as profit. And already we know that what we want to focus on are the cash flows. I mean, if you think about making an investment, the cash flow happens at date zero when you buy the asset. It doesn't happen later on when you make the depreciation. Okay, when do you need the funds? When you're making the purchase. This is going to lead us to realize that accounting rate of return is probably not the best one. So let's firstly explain what it is and look at its pros and cons. The accounting rate of return is basically a return on assets ratio. So basically what you're saying is, what's our accounting profit over the period? And here we say average after tax, but realistically, if you're looking at it for a whole year, you're basically saying what is the rate of return? And what's the average investment? So how much investment did I have at the beginning of the year? How much did I have at the end or the period? Take the average. That's a bit weird, isn't it? I mean, think about what if my assets at the beginning of the year are 10 and at the end are 100, and I only put the extra 90 in at the end of the year. Yeah, strictly speaking, I should be calculating some sort of weighted average perhaps. But more importantly, should I be using it that way anyway? Should I be calculating a different rate of return? Anyway, I'm ranting. Let's look at what it is. That's how you calculate it. And whether to accept or reject it, you compare it to some preset rate of return, whether it's a cost of capital or what have you. Okay, if it's above, you accept it. If it's below, you reject it. So an example. Let's say a firm can acquire a machine for $18,000. It's going to result in an increase in its after-tax profit by $2,000 a year. The life of the machine is 5 years, and at the end of 5 years, it's got no value. All right, so what does that mean? It means we're going to have depreciation on the machine. If it's 5 years, that's going to be what, 3,600 depreciation per year? Is it? Have I done that right? Let's have a look. The accounting profit is 2,000 per annum. Okay, so here's an example. A firm can acquire a machine for $18,000. This will result in an increase in its after-tax accounting profit by $2,000 per year. That's after depreciation. Okay, so total effect will be $2,000 per year additional. The life of the machine is 5 years. At the end of 5 years, the machine has no value. So we can work out what the depreciation is that's gone into calculating that 2,000 profit. So accounting profit is 2,000 per annum. The investment is 18,000. That's the amount we stumped up for the asset up front. But the average over the period of time is 9,000, or if you calculate it for the first year, it'll be 18,000 at the beginning, 18,000 less 3,600 at the end of that year. But over the life of the project, it's 9,000. See, already it's dodgy. The period that you measure over is going to give you different rates of return. So 2,000 per year divided by an average return of 9,000, it's 22%. If I did a net present value calculation, I think I'd get a different answer than the accounting rate of return will give me. So the first problem is we don't agree with the definition. Do you include the incremental profit? Do you include depreciation? Do you not? Should you be using the original investment? I mean, if you've got a rate of return, surely what matters is the original amount you put in. What's all this stuff about the average? So of course that would change the rate. Now, if it's consistent, it doesn't matter. But the point is, it can give you different answers from say, NPV. Okay, and one of the fundamental problems, by now that accounting is potentially a dodgy number. We make a lot of estimates. Okay, we're still making estimates with cash flows, but some of the accounting estimates are a function of the incentives of management. Do I want to measure profit this way or that way? So, how you measure accounting profit, all that subjectivity comes into the accounting rate of return. Okay, second example. Let's assume that a firm is looking at replacing its only metal fabrication machine. It can choose one of 3 machines. Each has got a $9,000 cost and a life of 3 years. And what's different are the method of operation and the timing of operating cash flow. You only need one machine. So using the accounting rate of return, as your sole selection criteria, which would you choose? I shouldn't have put a pause there because we need to see the numbers. Now, look at this. We've got profit of 3, 2, and 1 for machine 1, profit of 2, 2, and 2 for the second, profit of 1, 2, and 3 for the third one. Total 6,000. Accounting rate of return, you've got 2,000. Average investment is 4.5. Rate of return is 44%. They're all giving you the same. But which one would you choose? Pretty obvious to me. From a risk perspective, I have to choose machine 1. I mean, it's giving me the cash flows up front. Hey, look, if I invest $9,000, then if I'm investing $9,000, it's costing me more than. I assume. I mean, this is a silly example, but would you rather have 3,000 than 2,000 and 1,000, or 1,000, 2,000 and 3,000? Clearly, if money has a time value, if you've got some more money up front, you can redeploy that somewhere else. It's less likely you're going to have to go for resources somewhere else. So clearly, machine 1 is obvious. Yet, obviously the one you want to choose. Yet the accounting rate of return gives you the same accounting rate of return for all of them. It doesn't take into account the timing. And that's where accounting rate of return falls down. So what are its advantages? Well, the numbers are already there. You can work out profit. It's easy to calculate, assuming you agree on a consistent measure. It considers profit over the whole life, but it doesn't take into account the fact that the timing does matter. And it's related to a basic, return on assets ratio that all of accountants do to assess business performance. So disadvantages. Okay, I've already talked about accounting profits. Dodgy as. Because it doesn't include the rate of time value of money, isn't meaningful. I mean, if I get a small return in the early year, large return in the late year, or if they're reverse time-wise, surely I want the latter. Surely more return now is better, because when that return has come in, that cash is available to be redeployed somewhere else. Oh, hang on, this isn't even cash, this is profit. Extra dodgy. Nowhere here are we factoring in risk. We're not discounting more or less for the fact that it might be a more or less risky project. What's the cutoff? Well, since this isn't cash flow, should we really be comparing to what cash costs us? Or do we use some other arbitrary cutoff? Okay, so accounting rate of return, some people will mention it, but you shouldn't really be using this because, to be honest, it's going to give you the wrong answer. Net preference of value gives you the right one. Okay, so let's move on to the next one.